Welcome everyone to a new edition of our Thank God It's Monday webinar series. Today we're going to talk about money. And in particular, we want to explore this specific role of money as a tool that for the first time in the history of civilization allowed the transfer of power from the hands of tyrants and despots to the hands of those who had the best ideas. And this ability to transfer power in the form of money to someone who has a great idea is what we call investment. And the reason why investors have traditionally been willing to do this throughout history has been because they wanted to earn more money and become more powerful. Now, about 20 years ago, something magical happened and investors started to think of other reasons to invest their money as well. They didn't just want to make money, they also wanted to have a positive impact on society. And that's how impact investment was born. So to talk about impact investment, we have today an expert in the field. After a career in the world of capital markets, he's actually created his own impact investment paradigm. He calls it TILT. Tom Haslett, thanks for accepting Timothy Henry's invite and being with us today.
Avi, thank you so much. It's a gift to be here and to join you and your colleagues on Thank God It's Monday. I really look forward to our conversation and the chance to raise my own consciousness.
Me too. Thanks a lot. So why don't we begin with a sort of historical overview of the world of investment? I bet most of our audience may be familiar with some of the topics we'll be discussing, but not all of them. So I think it would be a good thing if you could give us a brief intro to how impact investment emerged from the world of capital markets.
Awesome. Well, I'm going to take license with your invitation to go back in time to even as long ago as 500 years. I think it's important to see capitalism as it's evolved and to understand how impact investing, as you said, is such a new phenomena. As long ago as the European colonization of the Americas, coincident with that was the enslavement of people in Africa, which laid the foundation for some of the challenges we're facing today in the United States and around the world. And so just as that was the apogee, if you will, of extracting financial capital from human capital, we also see in the 1800s the movement to extract resources from the earth. So drilling holes in the ground and bringing up oil and gas and minerals. We see evidence today of climate change and how we've destroyed natural capital, environmental capital, for the sake of the alchemy of converting it into money. And so as we move through our history, even today, we've got situations where I personally have a smartphone that tells me where to go and how to get there. And I'm willingly giving away my privacy and my friends in order to gain, through the freemium model, access to information in exchange for giving up my privacy and my civic capital. So our world is at a place today where we desperately need to regenerate these capitals. And what I think is important is to see the context of this movement towards purpose. And specifically, what's fascinating is to see that in the 1970s, the faith community gave us socially responsible investing, which was a great step in the right direction, avoiding the sinfulness of guns and tobacco and alcohol. And then as recently as the mid-90s, with the triple bottom line investment movement, which converts into ESG investing, we have this concept of sustainability, which is awesome because it's better than the conventional practices of simply going to the market to make money. But the difficulty we have is that the primacy behind ESG investing is still to maximize return. And financial return is still the be and end all for most investors who come to the market. And they're using ESG as a means of mitigating their risk. So by finding businesses that are less harmful, they are directionally going in the right direction, but we would argue that they still need to go further.
Okay, so we can, in a way, we can see the world, how the world of investment has evolved through a path of higher consciousness little by little, and that's taken us here to this point that you were just describing. And here you come now with a new paradigm, what you call TILT. How is TILT different from ESG and other investment, more conscious investment paradigms?
Yeah. I think TILT is different because our clients are different. And if we stop for a moment and consider that the persons who in our world today control wealth, we need to be very sensitive to understanding what their purpose is. And a TILT client is different because they're seeking to understand how their investments actually impact the communities and the environments in which they live or that they care about. So what a tilt client is seeking to do is to understand not only how and whether they can earn the financial return that they're seeking, but how through their investments they can actually regenerate some of that human capital that has been exhausted, some of that environmental capital that's been exhausted, or the civic capital. And in essence, what begins as a starting point for those conversations is a really simple question, but a very hard question. And that question is, how much is enough? How much does a client specifically need in order to support the lifestyle that they enjoy? Because if you're in the paradigm of simply wanting to have more, or to do better, or to even be the best, that means you're fixating on a relative performance. And for those persons who are seeking to outperform the market or outperform their peer group, the conventional practices meet that need. But a tilt client is seeking something deeper, is trying to seek something where they're not trying to outperform or outcompete. They simply want to achieve in absolute space the returns that they need, both financial and non-financial.
Could you say they are more purpose-driven than money-driven?
That's an excellent question. I think the short answer is they are both. And what I mean to say here is that if I was to talk to an American citizen at the end of the first quarter, and they had a big smile on their face, and I said, "Oh, Avi, why are you so happy?" "I'm happy because I lost 18% of my money." "Oh, how is it that you're so happy?" "Well, because the market's down 20%. I did better than the market." So a tilt client isn't caught in that trap. A tilt client is saying, I made 3.5% last year, and that's exactly what I needed to support the needs of myself, my institution, and the things that I care about. But let me tell you what else I did. I did these things. I regenerated this community by supporting the community's efforts to restore human capital. And we invested in schools. We invested in programming that supported, the youth of the community. So it's having both and being very purposeful and being very intentional as to the balance, the trade-off between the financial and the non-financial goals that you have.
So it sounds like if all investors in the world were like this, the world would be a much better place. So the question is, being in that business, what are you seeing? Who are the people today that move in that direction? Who are tilt clients? Do you think that this is going to become in the near future a major shift towards investment?
Yeah, the short answer is we do believe that's the case. And again, let's use a little bit of recent history to make the point. If ESG investing really emerged in the mid-90s, it's only in the last 4 or 5 years that we've seen quantum shifts in the behavior of investors to try and seek this doing less harm mindset. So as we confront existential crises such as climate change, existential crises as global pandemics, existential crises as racism, how are we going to meet that challenge? And so our belief is that there are more and more investors who are waking up, who are realizing that they have a responsibility, and that by using their discretion and by applying their thoughtfulness to how they deploy their assets, they can have an impact, a positive impact. Now, to be completely truthful, we have a handful of clients who I would describe to you as being curious and being courageous, because we are pivoting. We are pivoting to a new paradigm. We don't have 50 years of theory backed up by monetarist economics and capital asset pricing model construction. This is a new paradigm. We're applying techniques that are proven in the literature, but this is the first time that we've actually disaggregated a multi-capital approach to meeting the needs of restoring and regenerating those capitals that are in deficit.
So obviously this is a new paradigm. I would say more than new, this is actually a disruptive paradigm. And I'm wondering to what extent it is disruptive of the actual concept of capitalism. Is what you're promoting, this new paradigm, this new investment paradigm, something that can actually, I don't know, destroy capitalism? What's going to happen to capitalism in the strict sense of what capitalism used to be? How will this change capitalism? Will it still be capitalism if everybody moves in this direction?
I think it will be capitalism. And just for the record, I would observe that the thoughtfulness and the creative imaginations of most novelists who write about the post-capitalist period, most of those novels, most of those essays are dystopian. So from my point of view, let's hope that capitalism does survive. And let me explain why that's good news. The good news is that capitalism is a really efficient and effective mechanism for transferring information, prices. You know, the price of something communicated through the marketplace is very quick and highly effective and efficient for generating a response. What's difficult is when capitalism is assigned to consumption, and all of a sudden that critical question, what is enough, is lost by I want to win, I want to have more. That's where things go out of line. So the critical part of the paradigm that Tilt espouses is that the relationship between the asset owner, the wealth holder, and the community where the wealth holder seeks to have a positive impact, that power equation is mutual. I, as the investor, hold wealth, and I choose to invest my wealth in the community. The terms of that investment, the conditions by which that investment will be measured, good or bad, success or failure, will be adjudicated, will be determined by the community itself. And so in the old model, I have all the power as the wealth holder. In the new model, I'm sharing my power, and I see my relationship to the community as being at the center of my success.
Okay, so let's say that capitalism survives this new wave of investors, and let's hope they are very successful. So that seems like a reasonable possibility for the, let's say, the near future. But let's look into let's fast forward a little bit into the deeper future, and let's see what happens there, because what you're saying seems reasonable to me. At the same time, there are other realities happening in parallel, and one of them is that obviously one of the impacts of investment in the world and in progress is that it's dramatically accelerating the rate of technology. The rate technology evolves. Right. And technology is disrupting businesses, and this is happening at a faster and faster speed every time. So the end result is that the average lifespan of a company is getting shorter and shorter, and this is a key parameter for an investor, right? So what's going to happen when investors get to a point that start losing track of the average lifespan of a potential investment? How will they know what's the valuation of that company, what's going to happen to discounted cash flows, methods of evaluation, and things like that? How is that going to change the world of investment?
Yeah, excellent question, Javi. And the short answer is I don't know. And the fun of your question is that you're absolutely correct to identify time as the critical variable in this conversation. And what I mean to suggest from the start is that the investment time frame, which has evolved in the last 10, 15, 20 years, is very, very much shortening. The chief executive officer of the average listed company now is less than 5 years. The fiduciary who serves on the board of trustees is less than 8 or 9 years. And the 90-day reporting cycle, which determines how share prices move, is shrinking. The actual ownership, the amount of time by which an investor actually holds shares of a publicly traded company, is shrinking. So all of this points to the compression of time, which, to your words, is a very important variable in the valuation of bringing forward the future return of the cash flow. So I would answer your question this way. If we stop for a minute and consider how we've led ourselves to behave around making money, we keep shrinking the time horizon. If we think for a moment about the quality of life that we want for our children and our grandchildren, we need to expand the sense of time. So put differently, non-financial return, the ability to restore human capital, health, education, and well-being, environmental capital, biodiversity, air pollution, water pollution, carbon in the atmosphere. These are long-term challenges and opportunities for us to invest in. So it's very critical that we wrestle with the question you're putting in front of us. And the shorter answer, again, is I don't have a specific, but I do believe that if we can raise our consciousness to see our responsibility in a long-term context, that together with our purpose will lead us to behave much more thoughtfully, much more self-interestedly than we currently have been.
That's an interesting point of view. As I was listening to you, I was thinking in terms of purpose. Maybe what happens is, the lifespan of a company before it gets disrupted by the next one gets shorter and shorter. Money starts losing weight in the decision-making process, because of course you cannot expect to make so much money as you could expect before in the past, when a company could last maybe 100 years. But probably what you're losing in money, you're gaining in purpose, because we're accelerating towards a world of abundance where eventually maybe we will not need to work. So I think that purpose, from that point of view, could become the new money, the replacement of money at some point. What do you think about that?
It's interesting, and again, without getting buried into semantics, I mean, money serves many functions. It's a store of wealth. Could there be other stores of wealth? Yes, there could be. It serves as a medium for exchange. It creates efficiency in exchange. We don't want to go back to having to carry bags of wheat in exchange for bags of chicken. But nonetheless, there is a growing sense, I believe, and I think the colleagues at Tilt would agree with me, that money has grown to becoming an outsized factor in shaping our world. And what I mean by this is that if we hold in our hands the real economy, I buy from you a car, you sell me your car, and I give you 100 euros for your car. How many times has that money been amplified through the creation of money supply, M1, and all these different variables? And that's about a 3 to 4x in terms of the market capitalization of all the stocks and bonds that travel around the world. When we then lay on top of that all the money that is created by derivative structures, we have the proverbial tail wagging the dog, which is to say, when people say, oh, the market's up 2% today, that's good, it doesn't touch anybody. In the real world that we're living day to day, money has become an abstraction. And so its purpose as an element of our social political fabric has been woefully distorted. And part of what Tilt aspires to do is to bring this consciousness and to bring this awareness back into the real world, back into the real economy, to move away from the butterfly swap trade, which has a derivative of this and a derivative of that, but rather to say, how can I fundamentally apply my financial wealth in whatever form to creating something that is non-financial in terms of measurable return?
So that's fascinating, because as we're talking, I keep ideas just keep coming to my mind. And actually, I was just thinking of our previous conversation with Timothy Henry, who invited. And actually, I've noticed that Timothy is in our audience. So Timothy,
Greetings,
if
Timothy.
you're listening to us, which I hope you are, it would be great if you can actually ask your question live to Tom. And by the way, if anybody is in the audience, I forgot to mention this, please feel free to send us your questions via chat. Berta is with us picking up those questions, and she will share them with us in a few minutes. Actually, very briefly, because we are almost running out of time. So let me launch the last question before we start asking our audience. And actually, it's connected with something that I believe we discussed also with Timothy, and that connects nicely with what we were saying. If we just fast forward a few decades more into the future, okay, maybe a century, I don't know exactly how long, but I think that it's quite evident that sooner or later, what's going to happen, this rate of disruption, where a company, technology disrupts the previous technology, and a new technology that disrupts the next one, this will keep happening at a faster and faster speed. And what had happened so far, that technology was creating more jobs than it was destroying, eventually will start reversing, and will reach a sort of escape velocity, or whatever you want to call that, where actually technology will destroy jobs faster than it creates new ones. And what's going to happen when we are there? Obviously, one thing that's going to happen is that it's not going to be enough work for everyone. So I think we can see this reality from two completely different perspectives. We could see ourselves traveling to a world of you or me, where there's not enough work for everyone, or we could be traveling to a world of you and me, where we don't need to work. Not everybody needs to work. And this is a fundamental difference. There's not enough work, a view of scarcity, versus we don't need to work, which is a vision of abundance. So do you think that actually impact investment, what you are doing, is just a link in the highway to this world of you and me?
I sincerely hope so. And I made reference to this a few moments ago, but let me restate it. The existing form of capitalism is highly competitive. I win, you lose. Zero-sum game. You know, the win-win paradigm, as has been exposed, is a very difficult paradigm to point to and say it's really true. And so what I think you're asking, Javi, in this question is actually very important. Do I need to win? What is it about winning that gives me any satisfaction? What if I just knew that my own needs were met? I had enough. And then the second question I would invite us to consider is, how about my community? Is everybody in my community have enough? And if I can answer that question truthfully, yes, they do, then I'm in a very, very good place. And then the last question, which I'll leave you with, is who and what is my community? So you're inviting in this question the challenge of stretching our brain from the self-interest and the self-contained me and my family to me and my community, and me and my community and the larger society. So coming again to your question, I don't know how technology will disrupt labor. I don't know with any precision how it will create winners and losers, which is the old paradigm. What we need to understand is that the political social economy that defines our daily lives also has to change. And we'll have to see ourselves in relationship to institutions that have served in the old capitalist model, evolving themselves to serve in the new capitalist model. And those new institutions have to have a whole different set of priorities and a whole different set of purposes in order to complement the evolution of the capitalist system itself.
Great. I keep asking you questions nonstop for another hour, but unfortunately we're running out of time, and we definitely need to open up questions to our audience. So Berta, do we have questions?
Yes, we have. So Xavier Albaladejo was asking, thinking in this way, long-term impact, investors should not force profits in short time, therefore not forcing companies to take short-time decisions, which is currently leading to unsustainability. Continuous growth maybe is also impossible. What do you think?
So two questions that I hear in this. And the first is, as a shareholder, as an investor in a company, you have a voice, you have a responsibility to express your intentions and your purpose. That's especially effective in a private illiquid investment than a public company. If I have 100 shares of Apple Computer, it's difficult for me to tell Apple what to do. But nonetheless, the accountability of the owner is absolutely at the center of what we're pushing. The second point that you speak to is the limits of growth, which is a very interesting dimension. And that has to do with the natural laws of biology, chemistry, and physics. And as we continue to consume against the human capital, the environmental capital, and the civic capital, we will run out. So this whole question of growth for the sake of growth and GDP measurement as a measure of success or failure, these are all dated structures. These are all dated approaches to understanding how our economy needs to perform in the future. So they're excellent issues. And yes, ultimately, coming back to Javi's question about time, this is the key piece. How comfortable can we become about extending our time horizon to see the complexities and the interactions of the holistic self?
Thank you. I think Timothy wants to ask something. Maybe Berta, can you give him the mic so he can actually talk out loud?
Yes, I will do it. So I think now Timothy should be able to.
Yes. Can you hear me?
His mic.
Yeah, we cannot see you, but maybe you can turn on your video.
I think it's not an option.
I don't think I can.
Okay.
But
okay.
Let me just ask the question before we run out of time. You know, Tom, as you speak about community, I wonder if you could also sort of connect the dot between the concept of community and what is emerging as sort of a stakeholder capitalism and a move towards asking boards and companies, you know, what is their impact on their stakeholders and how are they going to track and measure that? I wonder if you could just connect those dots for us.
Timothy, thank you. It's a very important question. And as I referenced earlier, it sits at the heart of our philosophy. if that power relationship between the wealth holder and the community isn't clearly defined with shared measure, then the whole argument of how one can measure non-financial performance is very difficult. And again, to use history as a tool, the primacy of Milton Friedman's theories of shareholder primacy, amplified by Ronald Reagan and Margaret Thatcher in terms of economic history and the political economy that grew around it, that is finally being debunked. Last year, we had the CEO roundtable who all sat around and said, these are the things we care about. And the critical question we have to ask ourselves, again, as owners, to the question that Berta read for me, how are we holding ourselves accountable? How are we holding ourselves as the owners of this capital to the performance of the companies that we own? How much pressure have we and will we be able to apply on them so that they're meeting the larger goals of a multi-stakeholder framework? So again, directionally, we're moving in the right path. The question I would offer to us, and again, has to be with time, how urgent is the feeling and energy around this question? Are we moving quickly enough to care for and meet the needs of the consumers who consume products that may or may not be good for them, the employees, the suppliers, and so forth?
Okay, fantastic. Thank you very much, Tom, and thank you, Timothy, also for being live with us today. With this, we're going to end with our two final questions, which always ask all our guests. And the first one is, what does conscious capitalism mean to you? How do you think businesses should evolve going forward after this crisis?
Javi, that question is for me. Yeah. Excellent. So I think as we come through COVID, the S in the ESG framework has been elevated. And so we're seeing evidence of many companies responding to the crisis by improving their treatment of employees, or at least they're paying lip service to that. The real question that I think we have to ask ourselves and hold the leadership of companies, both the managers and the fiduciaries, is, have you truly integrated into your philosophy and your culture a commitment to regenerating capitals? And from my point of view, to just play with the word consciousness, consciousness is awareness. Consciousness for me is being more aware, more attuned to the needs of my community, of my larger space. And I think we have a critical need around the world, not just here in the United States, to amplify our voices and demand that if we hold the capital under our names.
Okay. Very good. So with that, I'm going to ask you, who would you like us to invite to our next session, and why? And your question for him or for her.
So I've been thinking about this, and there's a gentleman, his name is Chris Katarna. He wrote a brilliant book called The Age of Discovery. And Chris is he's many things, but he is first a very thoughtful person. Who understands and has the empathy and compassion to see beyond himself. And thus, I would hold him up with great regard as having a high level of consciousness. He also takes a fresh look at where we are and where we're going. Like many of the comments we've shared this afternoon, he has a historical context, but he bridges that historical context into the future. And I think he would be a very thoughtful contributor to your group's discussions.
Okay. Is there any particular question you would like to ask him?
I would ask him the question that you asked me, which is how technology as a disruptive agent is going to influence not just the capital markets, but how we organize ourselves, how we organize our lives, our relationships with ourselves, with our friends, with our families, with our institutions.
Sounds good. We'll definitely make sure he gets your question. Thank you very much, Tom. Before we go, is there any closing remarks that you would like to make?
Oh, you're very kind. I first want to say thank you. This has been a really interesting opportunity to chat, and I appreciate the opportunity to be with you. I do have a last thought. I'm a great fan of Albert Einstein, and I'm paraphrasing here, but he invites us to think for a minute about, if you're trying to solve a problem, and you're bringing to the solution the same thinking that created the problem, it's very unlikely that you will succeed. So if investors are seeking to make the world a better place, I think investors need to think seriously about what their intentions are. Because if we're coming into this conversation with the same intentions that created the problems, I don't think we'll have success. And within that, do we have the compassion, the trust in each other to make these changes? And are we ultimately brave enough to step away from the conventions that have held the herd to behave the same way? Who's going to split off from the herd here? Who's going to be brave enough and courageous enough to break from the herd and to find a new path that won't lead us to our own self-destruction and suffering?
Fantastic. Thank you very much, Tom. It's been a real pleasure talking to you today, and I hope that everybody has enjoyed it as much as I have. I also wanted to thank our audience and remind you that the next session coming Monday will be with Keith Radzi. He is the #1 New York Times bestselling author who recently published Leading Without Authority. And he will be sharing with us his ideas on new leadership paradigms. So thanks again for joining us, and hope to see you all next Monday. Take care.
Bye.